It's Earl, the money coach, and today's topic is going to be what's the best investment strategy to put my money in? Are they fixed accounts? Are they variable accounts? Or are there index accounts, which I should use towards my retirements and investments? But I always tell people, before you figure out where should I put my money, you need to know the differences of how they work. So let's give a quick breakdown. Let's start with our fixed accounts. Now, what are your fixed accounts? That's your bank, that's your checkings, that's your savings, those are your CDs. These are all accounts that you know your money's safe. It's protected. You're not worried about what's going on in the market. You have your money in those accounts. You're not going to lose money. But most fixed accounts have what we call LROR, which stands for low rate of return. So even though your money's safe, you're going to have that low rate of return. Is it going to outpace inflation? Most likely it's not. So most people know about your fixed accounts. Then you have your variable accounts. Now, what is a variable account? That could be your 401k, your IRAs, your stocks, your cryptos, something that's in the market where there's market volatility, where you have your ups, you have your downs. Who knows what's going to happen in the market? Last year, 2020, they were down 19%. So a lot of people who have 401ks and strategies, they lost a good chunk of their money last year alone. So that was in a variable account. Obviously, you have time to recover. But remember, in variable accounts, what goes down doesn't mean that has to be the same thing to go back up. Let me give you an example. If you have $100 and you have a 50% drop, most people think you need a 50% bounce back just to break even, but that's not the case. Because if you have $50 and it goes up 50%, that's only $25. So now you're at $75. So $100 that drops down to 50 with a 50% drop, you need 100% gain just to break back even. So a lot of times you hear the market's back up 19%, but are you really back up 19%? So that's your variable account. And then you have your index account. Now, what are indexes? You have index in the S&P 500. You have index in your life insurances. You have index in your annuities. Now, what indexes do is they give you a ceiling and they also give you a floor. All right. And now what's great about that, the floor is regularly zero, meaning zero is your hero. If the market crashes 15%, you have a 0% floor. You're not losing anything. But now you also have a ceiling. Now that ceiling, they call it a cap. Now that cap rate may not be what the market does that year. So for instance, if the market does 20% this year, your strategy may have a 15% cap, a 13% cap, an 18% cap. So you might not capitalize on all the gains, but you're not being affected by none of the losses. Now, folks, that is so huge. But remember, there's pros and there's cons for everything that you do. A lot of your index accounts, the pros are you're never going to lose money. But what's the con? It may take some time. It may take 10 years, 15 years for that guaranteed growth to get to where you want to be. Your variable accounts, guess what? You could double your money this year, but you could also lose your money this year. And then your regular fixed accounts, we understand that, look, if you want it to grow, it's going to be up to you how much money you're putting in there. So you have to understand your fixed, your variable, and your index accounts to have everything work for you. Now, my suggestion always is have yourself a blend of everything. Have some of your fixed accounts where you know your money's safe. That's your emergency funds. Have your variable accounts. So if you want to be a little bit risky, get a little bit more profit. Have your index accounts. If you know what, I'm getting closer towards retirement, I don't want to take any losses. Because I tell people there's something I call the retirement red zone. Now, what's a retirement red zone? It's very simple. It's 5 years before retirement, 5 years after retirement. That 10-year period, that retirement red zone, you don't want to be losing money. Because a lot of people don't think about what happens once they retire. Imagine you have your money in a variable account, a variable bucket. You hit retirement, and then 2 years later, the market crashes. Now you just lost 15, 20% of your whole retirement. Because guess what? It's still in a very volatile bucket. So I always tell people, understand the difference between your fixed, your index, and your variable accounts to get the best profit and the best bang for your buck in your account, because everyone's different, but you have